everyone. Thank you for joining the Cartus webinar series, and thank you to everyone who's able to join us today. We will be presenting a series of webinars with various topics impacting our global mobility industry, and given how fast the landscape is changing, I'm sure we'll have plenty of content to come. A recording of this and other webinars are located on our Cartus Content Hub. Our focus today is on the impacts to the US and Canadian home sale programs and other domestic areas. I'm Morgan Snapp, Director of Business Solutions here at Cartus, and I've been involved in the mobility industry for several years now in a variety of different roles, as well as serving on the Rocky Mountain Relocation Council's Board of Directors. The pandemic we're facing, along with the resulting economic and social fallout, are unprecedented, and we hope to provide some clarity on concerns that impact you and your program. Today, our panelists share their perspectives on what the global mobility landscape may look like as the world begins to reopen for business. We certainly understand this is a fluid situation, but we did want to start focusing on the light at the end of the tunnel. Before I introduce our panel, I'd like to highlight some key housekeeping items. If you're having technical issues, please drop off and rejoin our webinar. This call is being recorded and will be available for future viewing. Attendees are in listen mode only. If you have a question, please use the question area in the webinar, which has a voting feature. I know the panel will be very engaging with their topics, so if we're not able to get to all of the questions, we'll be sure to get the panelists' perspectives on the top questions, and we'll send those out to everyone who's joining us today. Let me introduce our panel of industry experts and kick off our discussion. Joining us today are Holly Klontz with Train Technologies, Phil Crawford, Certified General Appraisal with Voice of Appraisal, Megan Dutt with Guaranteed Rate Affinity Mortgage, and Pam Ewell, our Senior Vice President and General Counsel at Cartus. Let's dive in. All right, Phil, we'll start with you. Can you break it down for us, what you've seen in the last month on the macroeconomic level when it comes to state and mortgage markets?
Sure, thank you very much, and I appreciate all of you for having me. I am bummed that you can't see my background. I'm very excited about that, but that's okay. The big question that has taken place in the last 30 days is what hasn't happened. We've seen a lot of activity, of course, with the economic shutdown, coronavirus, COVID-19. So as real estate appraisers, it's very important for us to be able to sort of see that moment in time where the market either corrected or changed and is going into a different direction. And again, I'm not saying that the market is going to go down or the market's going to go up. I'll explain where I'm going with that later on during the webinar, but we just sort of need to define the exact time as to when things probably took a turn or will take a turn. So if you take a look at the history of the 10-year Treasury yield and the 10-year Treasury bond, that kind of gives you a good indicator as to when the market started to see the full impact of the COVID-19 virus. And if you monitor the 10-year Treasury, and unfortunately I can't show it to you here, but if you monitor it, the yield on the 10-year Treasury note went below 1% for the first time in history on March 5th, 2020. Now, on March 5th, 2020, that is a day as a real estate appraiser that I would consider to be a data point 0. So that's that point when we, at that time, knew that the COVID-19 virus was going to be something that was going to affect markets throughout the world. The reason why the 10-year Treasury went below that 1% on March 5th was because a lot of the money throughout the world was driving into safety, and it was driving into that 10-year long bond. So we do monitor that very, very closely. A lot of other appraisers out there as well have started to define their data point zeros within inside of their marketing areas, and some are the same when it comes to March 5th. My friend Ryan Lindquist, who lives in Sacramento, California, is a very popular appraiser out there. He's using the day that Tom Hanks was diagnosed with the COVID-19 virus because that day caused a reality to take place in the California markets, and many listings immediately went off the market, and people started to, basically shelter in place. My other friend, Jonathan Miller, out of New York City with Miller and Samuel, he's using March 15th, that Sunday, when the Federal Reserve Bank lowered rates to basically 0 on the discount rate and blew out their quote-unquote bazooka. So what basically has taken place in the last 30 days is unprecedented. It's been a shutdown of all civilization. And as appraisers, we need to now focus in on where we're going to be. We need to basically define what post-COVID data is and what pre-COVID data is. And now, of course, with these dates, the time between March 5th and March 15th, that's really where we're starting to go into the post-COVID world. So we're really focused in on that. We're trying to understand where markets are going to go. Sort of a lot of markets are in a holding pattern at the moment, and that will be our definite moment in time. The weird thing about the COVID virus, it doesn't have an actual date of tragedy. It's not like September 11th or the Space Shuttle Challenger or the Kennedy assassination or Pearl Harbor. It's a creeping tragedy that took place. And that's very important for real estate appraisers to keep an eye on. So as most of you know, it's been a very dramatic 30 days. And of course, the situation with oil yesterday adds even more drama to it. So we'll continue to monitor the markets as we move forward.
Awesome. Thanks so much for that insight. Some have talked about introducing a curbside appraisal given the rules and regulations in some jurisdictions due to the shelter-in-place restrictions. What has been your experience and homeowner feedback with this type of an appraisal?
Okay, so it's a great question, and yes, we've been using what is known as a curbside appraisal. I've had experience with it for the past 2 weeks. It's been a good option for a lot of transferees, and not only that, for a lot of homeowners as well. Remember, a lot of homeowners do not want us coming inside of their homes for the same reasons we don't want to go inside of theirs. So the curbside product has turned out to be something that I am starting to enjoy. There is a learning curve in it, but basically what ends up happening is I drive to the property, and as soon as I'm at the property, I have the homeowner understand I'm in the front yard, and we can establish the fact that I'm at the property. It's very important to do that, to establish that the appraiser is on the site or the appraiser's assistant is on the site. And then after that is done, you have two options as an appraiser. We either do the exterior work where the measurements are performed if the jurisdiction that you're in will allow that. Sometimes the jurisdictions won't allow that. And then, of course, at that time, we like to do a FaceTime type of tour, if you would, having the homeowner take us through their dwelling. And you know what? There is a learning curve to it, but if you handle yourself correctly and professionally and start to develop your pattern as to how you would like the homeowner to navigate you through their home, it actually is a very positive experience for everybody. And everybody understands the circumstances that we're living under today. So if an appraiser goes in and sort of uses an attitude of this is going to be a teachable moment, where as you walk through the rooms, you're verbally communicating with the homeowner exactly what it is that you're thinking and what they're thinking. You know, a lot of times when we're on inspection, a lot of the stuff that we analyze and a lot of things that we note, not only do we note on our iPads and our notebooks, but we also take care of it in our minds too. We don't really share everything. This really does open up a different layer of communication for homeowners so they can see and explain to us all of their upgrades and improvements as you go through the house. One of the things I like doing in the Ohio market is going down to the basement with the homeowner in a FaceTime interview and sort of finding out which rooms we sit under. You know, which room are you under? Well, I'm under my breakfast or I'm under my kitchen. And a lot of times what people will say, well, how do you know I'm under my kitchen? And I'll say, point the camera up and let's take a look at your plumbing. So they start to learn things about their house they maybe didn't know before. So as long as you handle it in a teachable manner, where you're there to explain what you're doing and the data and information that you need from them, it is really a good positive experience. And I think this is something that's just not going to be a short-term fix. I think the issues with this virus may be around for quite some time, and this could become more of a practical way of doing our business, more of a practical application when it comes to interior and exterior inspections.
Here in Colorado, we've really had a lot of shutdowns with our shelter in place. One of those has been that they've put a complete hold on any type of in-person interaction inside of a home during a real estate showing or viewing. And, you know, as those things start to be lifted, obviously people will want to start touring homes again. Do you anticipate on the appraisal side having the curbside appraisals be a long-term strategy that people will prefer, or do you see them going back to a more traditional sense?
I think given the news that Dr. Fauci and all the government officials are saying, where we're talking about an 18-month process here, I think this is going to be more long-term. And even after that's all said and done, depending on how things go, there is going to be a personal space issue with people moving forward. No, some people are not going to care about it, but other people will. And I think that when you're talking about technology and showings, that will help us out as well. As the technology on the sales side increases, more and more virtual tours, more definition of virtual tours, that will end up helping us out as well. When it comes to our business, when it comes to the third party unbiased, we're there to really analyze that home. I see us more relying on perhaps home inspection reports and other data sources, as well as the curbside, to get a better indication of what the value is and most likely the overall condition too. But I do see this being something that is somewhat permanent for at least the next year to 2 years.
Great, thanks so much for your insight. Megan, let's jump over to you. First question that we have for you is, what technology enhancements will assist in keeping closings on schedule now and in the future?
Good afternoon. And I just want to quickly mention that before I get into what's being done to ensure closings occur, interest rates are extremely low right now for the reasons Phil just talked about. So we've entered into very much a refinance market. There are a lot of people looking to refinance their mortgages, which is wonderful. But most of the people on the phone are involved in relocation, and we're all a little more concerned about purchases. And I think I can speak for our entire industry when I say purchases continue to be our highest priority loans, and we will never make them wait in line behind refinances. So those continue to be priority for sure. The lending world over the last several years has really embraced technology in general, and we've largely moved to a paperless program product anyway. Most lenders have a digital platform available to their borrowers, and what that means is borrowers can apply for loans anytime, day or night, 24 hours a day. They can go in on their own computers, tablets, phones, and enter all their information, which makes for a cleaner and probably less errors on a loan application. Once they complete their loan application, the rest of the process as well is quite paperless and full of technology. One product that's used is called Transferees. This allows for a borrower to download documents, review them, sign them, upload them, and send them on to their lender. So in the old days of getting a mortgage, you either signed some initial paperwork in person with a loan officer, or more typically you received documents overnight. So we do still have some borrowers that prefer to get documents overnight, but most will do the e-signing electronically. There are other products as well and services that speed the process. Account check, for example, is available to all lenders. With account check, a borrower does not need to provide their own paperwork, supporting paperwork for assets. With their permission, the lender can go out and retrieve asset information electronically. Most lenders work with a third party called the work number. The work number will provide a lender with W-2s and pay stubs. So the borrower doesn't have to provide that paperwork. There may still be some documents that a borrower will be uploading and sending to their lender, but it's gotten largely much easier for a borrower and largely paperless. Phil talked about the appraisal process. That's very exciting for us right now, that we are able to see workarounds in the industry. We have a network of about 700 appraisers that are doing things similar to what Phil outlined. Occasionally, a loan will get what's called a PIW, which is a property inspection waiver, which means that appraisal is not even necessary. In relocation situations, we will always give the option to the transferee of completing an appraisal. They probably will want to know that the home is worth what they're paying for it, as does their company in case they're relocated again. Now, the paperless goes right through to the closing, and there's a hybrid option available that we rolled out last year. I think a lot of lenders have rolled it out as well. With the hybrid option of closing, it allows a borrower to download their closing documents at 12:01 a.m. in the time zone of their closing and e-sign certain documents. And then when they go to closing, a physical closing, they only have to wet sign 4 or 5 documents that need to be notarized. So the market is, it's it's robust. There are some changes. We're not seeing underwriting go back to the crisis, the financial crisis, but we have seen some tightening. There are some lenders that are now not doing less than 20% down loans. And the other thing I'll make note of to this audience is that previously a verbal verification of employment was required to be done within 10 days of closing. That has shortened to just 3 days before closing. So in your relocation roles, you may get the request to verbally verify employment. This was shortened due to the fact that there have been furloughs and layoffs. So the underwriters are requiring that now.
That's a lot of great information. Thank you. Are you seeing closings still completed during the crisis? And what do you expect once we start to emerge from the crisis?
Yeah, absolutely. And this is another thing that was looking to change probably in 2020 or 21. The industry was moving towards virtual closing. There are currently 35 states that have laws on the books that allow for remote online notarization, or RONs. So these states allow for electronic notarizations to occur. As a result of this crisis, we've seen some executive orders in other states that are allowing for it as well. So how this process works is we partner, for example, with a company called Notarize in Massachusetts. They have a large staff of notaries, and the borrower will go online on the day of their closing, make an appointment to sign their documents, and at the appointment time, they are connected through their camera on their computer with the notary, and they're able to complete the closing electronically. The companies that are providing this are still getting up to staff, so it can be a little clunky right now for borrowers because there probably aren't enough notaries available at all of these companies just yet, but they are staffing up. And one thing I will note that if a closing, for example, is today, April 21st, a borrower will need to complete their closing, their signing by midnight. So these companies are available 24 hours a day. A transferee could go online at 3 a.m.
Okay, well, we will switch gears then. And we did have an extra question that we're going to ask Megan, but we'll make sure her technology gets back up before we go to that. So Holly, I want to switch gears and look at the corporate side, if that's all right with you, and talk about how your company is addressing current relocations in progress right now during the crisis.
Great, thanks Morgan, happy to be here. Just quickly wanted to share, if most of you don't recognize the Train Technologies name, the old Ingersoll Rands that I represented spun off our industrial business and merged with another company. So I'm now representing Train Technologies and just wanted to point that out. So the question, or the answer to your question, is really we're addressing them on a case-by-case basis. So Train Technologies is considered an essential organization, so our workforce is still strong, working, visiting customers, selling and making product. So we still have critical people that need to relocate, and we're just dealing with some of the changes in the industry that both Phil and Megan just described as our people are going through them. And then we're addressing just exceptions as they come up. So we've extended some temporary living or allowed an employee to delay listing their home as we work through what COVID-19 has done to the real estate industry. So we're really just addressing on a case-by-case basis. We haven't put anything on hold. We still have critical workforce that needs to relocate. So we're just trying to roll with the punches and deal with these issues as they come up.
Awesome. Have you really noticed any trends that you've seen with your HR teams in regards to hiring practices or upcoming moves that you're going to be experiencing, things that are coming in the future once you start to emerge?
Well, we did see a short decline in customer demand. So we did furlough some of our production workers for a 2-week period as a result of that. We are still hiring critical roles. We did do what we are calling a hiring pause for 60 days. So we didn't put every one of our open positions on hold, but we did a thorough investigation of those to understand if any of those could be temporarily paused, but continue to work through the critical hires that need to happen. So we're still kind of rocking and rolling as we normally would, with maybe just a smaller population than we would have experienced a couple of months ago. So we're just, like I said, just working through it all, and expect to be completely back up 100% in the next few weeks.
That's awesome. I'm glad that you guys are doing so well. I know throughout the industry that we've heard some companies, especially non-essential deemed ones, are shifting a little bit more drastically than you are. So hopefully in the next couple of weeks, we really see some progress in the economic revamping, if you will. I know many of us are working from home now, and I'm sure that's the case for almost everybody that's on the webinar today. Do you anticipate that this shift will likely impact how your employees are working in the future, and potentially how it would impact future mobility needs and your program structure?
Sure. So, you know, because we're manufacturing product, it's difficult for a large number of our workforce to work remote. I'm actually working, as you can see from my background, I'm working from home, and most of our professional workforce that have the ability to work from home are doing so. You know, it's funny, we're actually more productive as we work from home. We have daily huddles with our teams and the larger HR solutions organization that our team rolls up into. Maybe it's because we're working more hours as a result of working from home, but we're more effective, we're more efficient, we have less technical issues than we have experienced in the past, where our folks have access to all the software that they need without issues. So it's interesting because as a result of the merger, the spinoff and the merger of the Ingersoll Rand brand, we are sharing our campus now with the new Ingersoll Rand in our Davidson headquarters in North Carolina. And we're in the process of having to shift buildings on the campus. So it's going to be interesting to see how it all works out. And will we have to move buildings? Are we going to work more remotely on a permanent basis? Will they see that we are efficient and effective working from home and not want to pay to house us all on campus? So it's going to be interesting to see. We haven't made any decisions about that, but it's been fun. We've been really trying to stay connected. So we do a lot of these like Microsoft Teams or Zoom meetings. So we're seeing each other and staying closely connected and more intentional about our connections. But it remains to be seen if we're going to go back to normal, what normal used to be, or if we're going to do something different.
Pretty exciting times that we're living in. Let's shift gears. And Pam, before we get to structured questions for you, having heard what everyone's had to share so far, are there any areas that you think are worth elaborating on or clarifying from a legal perspective?
Not so much from a legal perspective, but if anybody's interested, Notarize has a website, and at least at one point they had kind of some demos on that website as to how the remote notarization works, and it was very interesting to watch.
Great. Have there been any legal impacts to the US or Canadian home sale process due to COVID-19 and all the changes that are occurring?
Yes, one of the first impacts we saw was we were concerned about not being able to attend closings not being able to be held. So we developed an addendum to the purchase and sale agreement that protected both buyers and sellers. After that, we started seeing every jurisdiction, every closing having their own. So we've had to review all of those. And they mostly go through and describe the pandemic, and then they describe the things that might not happen because of the pandemic, such as not being able to attend closings, not being able to get inspections done. And most of them give you a period of time during which things will be suspended, and say that the parties should work to accelerate things if they can. And then there's usually a drop dead date for either party to terminate the agreement and walk away. and have the buyer's earnest money returned. We've seen a few outliers from individuals and companies. We saw one that said that if the buyer's investments lost any value, they could walk from the transaction. And of course, we need to negotiate all of those. On the title side, we also see a lot of the title companies asking buyers and sellers to sign what they call a gap indemnity. And that's asking the buyer and seller to indemnify the title company if between the time of the closing and the time of recording of the deed, anything appears on the record. Cartus usually will not agree to sign one of those that's joint with the buyer, because then we would have joint and several liability to the title company. And we're also limiting it to any actions of the seller. So any actions that Cartus took. So if somebody filed a lien against Cartus, but we're not indemnifying for other parties' actions. Those are the two main impacts that we've seen so far.
And have you seen any options around how to extend offers, or what happens when the home value decreases after an offer is presented, and what people can do in those situations?
Well, on the acquisition side, when you've got a relocation appraisal, that relocation appraisal is generally good for 120 days. And as we saw back in 2008 with the market decline, some clients want to extend the offer. If you're in a stable market, that's okay because the value isn't really changing much. But in a declining market, you could have what are called directed offer issues. And that's because the appraisal was only intended to be good for 120 days. And after that, the value of the home may be declining. And if you go ahead and use that old appraisal, the IRS could argue that the difference in value between the appraised value and the actual value of the home is a directed offer, and that part of the offer should be treated as taxable income to the transferring employee.
Any other insights that you want to provide in regards to the legal aspects that are just facing companies today in regards to their mobility programs, Pam?
No, I think each company is dealing with it differently. Some are busier, certainly people in the liquor industry and the gaming industry and things like that are very much busier, and others like Holly's company are essential and people are still working.
Awesome. Thanks so much, Pam. Megan, I think we've got you back online and working again. I did have a follow-up question for you. Sure. I know that you and the company primarily serve the U.S. market specifically, but we've had some people ask, can you offer any insights into the Canadian market and what's currently going on in their environment?
Sure, and nothing like computer issues to get the heart racing, so I guess I don't have to work out later on. Got my heart rate up. Yeah, we don't lend in Canada, so I don't know too much about Canada, but I did a little research, and they seem to be making the same accommodations for putting off, maybe pausing mortgage payments, but they seem to be pretty technologically advanced as well in allowing for notarizations online.
And with the recent CARES Act, what mortgage payment relief has being offered that you've seen, and will this impact future transactions for both buyers and for the companies?
Yeah, it shouldn't impact. There may be an impact to those people buying the relocation homes, but with the recent CARES Act, a borrower can approach their lender. They have to approach their lender. This is not an automatic. The lender can pause their payments for 6 months and do an automatic 6-month extension if requested. This cannot hit a borrower's credit, and it's available on any government loan. So that's a Fannie Mae, Freddie Mac, a VA, an FHA, or a USDA loan.
Do you envision any long-term impacts for people taking advantage of those situations?
I do not. There is a lot of protection around the program for consumers, and it's not supposed to hit their credit report, so we should not see any long-term impacts once the borrower is in a better financial situation and can start repaying their loan. What they will have to do is work with their lender to work out a payment plan, either to put the outstanding payments at the end of the loan and do a modification or pay in lump sums. My only thought is that if somebody bought their home recently with very little down and then is relocated and suddenly $10,000 gets tacked on to the end of their loan, we could be in a situation where they may be upside down on their mortgage. So that's a little bit of a concern.
Absolutely. Holly, we're aware that some relocating employees have been requested to be reimbursed for the stimulus check that they might not receive because their relocation expenses would put them over a tax threshold. Are you at Train considering this reimbursement, and what have you heard from colleagues in the market?
Yeah, thanks for that. So, it's funny, we started doing the research on the CARES Act, the impact to our employees, and found some just conflicting information out there about what companies were doing. I read one blog from a tax professional in the industry that everyone that their company had spoken to was planning to pay this out. And I thought that just doesn't sound right to me. So I had to dig a little further into it. And I really would encourage everyone to just actually educate themselves on the stimulus or the economic relief payment, because most people don't understand it's really an advance of funds for a 2020 credit. So we're just taking the wait and see approach. At this point, we have no plans to reimburse any employee. We will allow them to file their 2020 return, and if they...
So I guess problem and solution that we have to come up with, like you said, it is something that is an advance on their credit, and some people may or may not be receiving that credit right now or even in the future. So it'll be interesting to see what companies come to as a consensus for that. Shifting gears over to you, Phil. How are you forecasting the market for the next 90 to 120 days, given the current crisis and the market conditions?
Well, that's a big question, isn't it? That's a really big question right there. The few things that we're looking at that are very important as far as the appraisers are concerned is two big factors. Number one, unemployment, and number two, availability of credit, the ability to get a mortgage. So we're going to be keeping a very close eye on unemployment rates, what's going on in local markets as far as our major employers laying off, are jobs going to be able to be retained, things like that. Also, the availability of credit. As Megan was talking about, some lenders are starting to sort of tighten up a little bit when it comes to their credit. We know that JP Morgan Chase recently stated that they were only accepting an 80% LTV and a 700 Beacon score. So you may start to see a little bit more tightening in the secondary market as well. And Megan made a very good point in the fact that when it comes to the appraisals that we get in the lending side, the purchase transactions usually are put at the front of the line in those appraisal orders. And also, there's something going on inside the appraisal world. I need to discuss this with you really quick. In the secondary market with Fannie Mae and Freddie Mac, if you want to get a cash out refinance, then the appraiser does need to walk inside of the home and do an observation in the traditional manner that they did prior to the COVID virus. This is putting a lot of appraisers in a tough situation. It's putting a lot of homeowners in a tough situation. So I don't know if that's done on purpose or not to keep people from pulling money out of their homes or not, as far as cash is concerned, but that is an issue that's taking place. So unemployment and the availability of credit in the mortgage market will be extremely important going forward in the next 90 to 120 days. Is there going to be pent-up demand? I think the answer to that question is yes. There's going to be pent-up demand for housing, but at the same time, there's going to be a pent-up demand to put the house on the market. During this time of year in March, when the entire economy came to a halt, especially in February and March, there was a lot of sellers out there that were getting prepared to put their homes on the market, and they stopped. So if there is going to be pent-up demand when everything, quote unquote, opens up, it will take place, but it'll also be offset, I think, by a substantial amount of listings that will hit the market as well. Usually during bad snowstorms and bad winters, people are anxious to sell their homes because they've been in it for a long time, and that's with a snowstorm. Now they're sheltering in place. They're going to want to perhaps put that house on the market. So we're going to be keeping a very, very close eye on that. I want to run these numbers by you really quick. Listen to this. This is pretty interesting. This is in the Cincinnati market. I cover the Cincinnati and Dayton markets. In the past 12 days, listen to this. In the past 12 days, there has been 215 listings that have gone, quote unquote, back on market. 215 that have gone back on market. That's very rare in the markets that we've seen in the last 3 or 4 years. Of those 215 back on markets, about 50% are under contract again. So the fact that they went under contract almost immediately means that there still is the demand. So 50% are pending once again. The big question now is are those offers that are pending, those listings that are pending, will they be able to obtain their financing as needed? So moving forward, we're going to keep a very, very close eye on the number of active listings, the total activity, and also within different price ranges as well, because affordability may go up and may go down as time goes on when we get a better indicator as to what the unemployment rate is going to do. So lots of moving parts in the next 90 to 120 days, and it's going to be very important for appraisers to just monitor their markets. Honestly, almost on like a weekly basis, if not a daily basis.
Yeah, this summer will be very interesting for the real estate market, and hopefully it's successful for all of our real estate agents. This one is more directed towards Megan with maybe a little bit of insight from Pam, and it comes from our Q&A session sidebar. With the massive impact of unemployment filings and the risk of potential upheaval that it can create, do you envision additional underwriting requirements in the near future beyond what you're seeing right now?
It's entirely possible. There are already many extra steps in place to, as I mentioned, the verbal verification of employment. There is also an attestation document that a lot of lenders are now asking borrowers to sign in addition to their other closing paperwork, to just confirm that they don't expect to be furloughed or they don't expect to lose their jobs, those kinds of things. We are also seeing a little, as Phil mentioned, there's been some restrictions already with some lenders such as Chase requiring 20% down. Qualifying ratios have gotten a little tighter as well. So I think we've seen the adjustments, but there will be a lot more along the way as well in terms of verifying.
And Pam, from your side, are you seeing more of a valuation decline or inability for the buyer to qualify based on employment situation or circumstances regarding this crisis situation?
Yeah, what we're seeing is that some buyers are putting in those COVID-19 addendums that, even after they get their mortgage commitment, if their commitment falls through for some reason, that's an excuse to get out of the contract and they can get their earnest money back. So I think we're definitely seeing some buyers anticipating that mortgage lending can tighten up.
And in regards to rates, everybody knows that the rates right now are just incredible. But we have seen that the lenders are starting to get overwhelmed, or they were at the beginning of April. And it's reported that they're kind of increasing rates just to kind of mitigate and slow that demand. How can we ensure that, employees are getting as least impacted by the rising rates that are artificially inflated versus what should be coming in the future summer market?
Yeah, that'll be interesting. And I assume that's for me.
It is.
It'll be interesting to see, because I think we're all used in the relocation world, we're all used to our busy time being June, July, August. We may actually see this year, it's September, October, November. Relocation purchase rates are different than refinance rates. I have heard of lenders rushing up their rates a little bit to slow demand. So we could occasionally see that happen. Our loan officers are tasked with keeping in touch with their borrowers and having ongoing conversations to talk about the best time to lock into an interest rate. We're also reaching out and encouraging transferees that might have pre-approved several months ago to let us run a pre-approval again in case there's something that's happened in the market that might affect their pre-approval for when they are ready to go.
And for all of you attendees that are on there, please go ahead and submit questions. We want to make sure we're answering everything that you might have a question on while we have these experts here and available for you. Just to circle around to both Megan as well as to Phil, Do you anticipate any market stigmas with areas that are hit hard by COVID or geographical areas that seem to be more impacted? Or if there's a house that someone knows that a COVID infected person was sick in, do you anticipate any shifts in perception or valuation of those properties?
That is a great question. As a matter of fact, I was going to ask Pam that question too, because she was talking about a legal addendum for COVID-19 as far as an ability to remove a party out of a contract. We were talking about is a COVID-19 property disclosure form, and I have thought long and hard about that, and that could be an issue moving forward, very similar to a mold disclosure form as well. It just depends on how things react in the marketplace. We're not really sure how that's going to work. As far as a COVID-infected area or a quote-unquote hotspot, the market probably will end up taking over itself in those areas. Stigmatization will come in time. We'll have to just monitor it, but we don't have any indicators as to right now. But I do see in the not so distant future some sort of COVID-19 property disclosure form inside of sales contracts that most likely the National Association of Realtors would have to design.
Right, and Phil, we have seen transferees disclosing that, especially in New York City, in some of the condo buildings, that there are numerous residents that have tested positive. And I think eventually there may be an addendum, and it may be a disclosable item, especially in a single family home. And I think the realtors are also reacting to that because, you know, if they are in places where they can still show homes, they want to know that they're not going into a home where someone's tested positive.
Megan, did you have any insights from the mortgage perspective in regards to, verification of a loan in regards to certain areas that are hit hard?
No, nothing in addition to what Phil and Pam already talked about. We work off of from an underwriting perspective, we're going to look at what the appraiser notes and whether or not that's affected the marketability of the home.
And jumping over to you, Holly, have you seen anything going on with your current program or any of your colleagues you've talked to about how you're viewing your, your buyout programs or those types of situations in certain impacted areas versus others? Or what have you really seen from your side?
Yeah, I mean, I think it's similar to what a lot of this has already been shared. It's a wait and see approach. The organization, we have a self-reporting tool, so our employees are supposed to self-assess daily and report anonymously their status. So I don't know the exact number of employees that have tested positive across our base. And of those that have, I don't know what their status is in terms of whether or not they're a relocating employee, but I think, like what's been shared already, we're just waiting to see if an employee has an impact as a result. I don't have a lot of insight into that question, really. I think we're just sort of taking that wait and see approach and addressing it as it were to come up.
And just on the flip side, Holly, as we start to emerge from the current environment and things kind of go back to whatever our new normal will be, what do you anticipate potentially shifting from your mobility team to make it a little bit more of a fluid transition out of crisis mode to normal?
Yeah, I know. It's just listening to kind of what Phil and Pam and Megan have been saying. It got my wheels spinning around whether or not we'll be in a position in the near future to have loss on sale, significant loss on sales, and or as Megan mentioned, negative equity where an employee will have to be able to clear the mortgage to get through. So I'm wondering now if we need to be thinking about changes to the policy in order to address a situation like that might come up, especially in the hotspot markets, which thankfully we don't move a lot of people in and out of New York City, so in some of the other hotspot areas, but it's something that we should be thinking about and planning for, and I would encourage my peers to do the same.
And then just to circle back with you, Megan, for the VA and FHA loans, they often require seller-made repairs to be eligible. Have we seen any lending impact due to the fact that required lender repairs are really hard or even impossible to be made in this environment?
Yeah, that's a great question. And I haven't heard that we've had issues on our VA or FHA loans as of yet. I can look into it, but I don't have a good answer for that, because those would absolutely need to be done. The good thing is, if somebody is that close to completing a transaction, they likely will take the precautions with allowing a worker in to covered up and with a mask and gloves and all to complete the work.
I'll jump in on that question too. With VA also, they did lax a lot of their standards and made it a lot more flexible for real estate appraisers to do those purchase appraisals as well. And Veterans Administration did the same thing.
Okay. And then one more question, kind of open to the broad group, but we'll go ahead and start with you, Holly. If you could provide any best practices or tips for individuals or corporations based on what they see in terms of optimizing your current practices or your policies and moving forward into the future, what would those tips be?
Oh gosh, that's a loaded question. I think it's just preparing for the worst and hoping for the best, right? So just thinking about and looking at your current population, what, who's currently going through the program, where are they going, where are they relocating to and from, are they in hotspots, and can you make adjustments to your policy on an exception basis? I've talked to multiple peers over the last several weeks, and they're all approaching everything very differently. Some on strict hiring freezes, and they've put their relocations totally on hold. And us who were just kind of taking the wait and see and addressing things as they come up. I think it's smart to stay educated and aware, listen to these types of webinars. I know that one of the folks on my team, I've had her listening into every single webinar that's come up on the COVID-19, just so that we can understand and hear from multiple people in the industry what they're doing and what the plans are, and just but I think the resounding message that I'm hearing is we're all still trying to figure it out, and the long-term impact to relocation may be unknown at this point. So I think it's just staying educated and on top of and aware, and be prepared to make fairly fast recommendations to policy changes or process changes would maybe be my recommendation for the day.
And Pam, jumping over to you just on the legal aspect, do you have any best tips or practices for people?
No, just, the addendums that are coming through, we need to read them. We need to make sure that there aren't other items thrown in, some are very broad. And, from a legal standpoint, we're seeing the same as Holly. There's webinars, there's seminars on all of the very different impacts of COVID-19 on the legal industry. Privacy is another big issue that's being impacted with COVID-19. And so it's just keeping up to date with what's going on.
And then, Pam, when you speak about all the addendums and disclosures, we're assuming that a lot of them will go away once COVID kind of passes and the antiviral or the vaccine come out and we kind of really do get back to kind of a full normal. Do you expect these to be temporary, or do you expect to see some shifts in what people are asking for with addendums and disclosures?
Well, certainly I think people now realize that a pandemic like this can happen and it can affect real estate sales. So to the extent that state contracts don't have what attorneys call force majeure clauses in them, I think people are going to start putting clauses in contracts that say if because of some event we can't close, there is an excuse for performance. So I think that's probably going to stick around.
Yeah, it'll be interesting to see what our new normal looks like in the real estate market. Holly, another question just came up. Are transferring employees making any comments with regards to additional relocation benefits impacting their taxable income? For example, like extended temporary living or, extension of those types of benefits. And that, of course, additional expense would then impact their tax statements.
I don't know that our employees are thinking of it in that term. I think they're thinking about what is happening in the moment more than the long-term impact to their taxable income. And most of the employees that I've talked to across the organization are so happy to be employed and receiving their paycheck. And I just don't think that that is a concern. Obviously, if it came time for them to resign and they on their own and they had to repay, there might be a separate conversation that they would want to have as a result of an exception made through the pandemic. And would we address that exception to policy through repayment a little different? Maybe. I can't say for sure. We're pretty strict about repayment. But I don't think our employees are savvy enough at the moment to be thinking about the impact long term to taxable income, and more so focused on just what they need to do to care for their family right now.
And Holly, have you contemplated implementing home buying appraisals to ensure your employees are not overpaying for their home purchase side? Like just protection for you in case they should do another relocation, and then values not be impacting you as well?
Yeah, no, that's a great question. We haven't talked about that. It's a great point and something that we'll take away from this conversation and discuss as a team and with our account management team there at Cartus as to whether or not that makes sense for something for us to consider. It's a great question, great point.
Awesome. And just to bring up, we do have a white paper that's being released soon in regards to excuse me, I didn't say that right the first time, called Navigating Relocation Home Sales in Uncharted Waters. So be on the lookout for that. I think that'll really have some good legal insights to provide as well. Any other questions that that you guys want to put on the published board? We are ready to answer those. We do have a couple more minutes left. Otherwise, we can wrap this up and get on with our days here at our homes. I don't see anything else populating at the moment, and we are coming up on the end of the hour. So if you do have any other questions or anything like that, be sure to email your local Cartus representative, and they can certainly get insights for you and get some questions answered if something pops in your head later. Thank you all for joining. We're so glad that you could take time out of your day to be with us. Please be on the lookout for your next webinar. And like I said earlier, this is recorded, so you can certainly review it after it becomes live on our Cartus Content Hub. Thanks so much and have a great day. Bye.